the bedtime story of the big bank and the boss. Hello, and welcome to Midnight Macroeconomics, the place where we turn the complexities of the current global economy trends into a soothing story to help you catch up or fall asleep. Today, we're going to talk about a big puzzle happening right now. It involves a very important bank, a powerful leader, and a whole lot of money. This is an adaptation of the capital market participants that have concluded with certainty that the Federal Reserve, or called Fed, will resume its rate-cutting cycle on September 17, 2025. Part 1. The curious case of the calming cut. Imagine a giant, quiet machine that controls the speed of our economy. This machine is called the Federal Reserve, or the Fed. Think of it as the wise old guardian of the American economy. Its main job is to keep two things in balance: prices, ensuring that the price of things you buy, like your morning coffee or your rent, doesn't spiral out of control. This is called price stability. Jobs, making sure as many people as possible have a job. This is called maximum employment. The Fed's main tool to manage this balancing act is something called the interest rate. Think of the interest rate like the price of money. When the Fed raises this price, it makes it more expensive for banks to borrow money. Banks, in turn, make it more expensive for you to get a loan for a car or a house. This slows everything down like a gentle tap on the brakes. When the Fed lowers the interest rate, it's like hitting the gas. It encourages borrowing and spending, speeding up the economy. For a while now, the Fed has had its foot on the brakes to fight off rising prices. But lately, there's a rumor going around. A rumor that the Fed is about to hit the gas again by lowering interest rates. The smart people who watch the markets, the capital market participants, as the article calls them, are so sure of this that they've already started to act. They're betting on these rate cuts, and as a result, a few things have started happening. Stocks, or parts of companies you can buy, have reached record highs. Bond yields, which means the money you get back on a loan you give to the government, have gone down. The price of gold has shot up, and the US dollar has gotten a little weaker compared to other currencies. It seems like everyone is just waiting for the Fed to make the official announcement. So why is the Fed even thinking about cutting rates? Well, they're in a tough spot. Their two main goals, keeping prices stable and ensuring everyone has a job, are in direct conflict. On one hand, prices are still a bit high. While the number has come down, it's still above their comfort zone. And there are concerns that new policies, like tariffs, could make things more expensive. On the other hand, the job market, which has been super strong, is starting to show some cracks. The the numbers of new jobs being created have slowed down, and the unemployment rate is beginning to creep up. In fact, one of the Fed's leaders, Chairman Powell, recently hinted that they're getting more worried about jobs than about prices. This brings us to a huge question. Is the Fed making this decision based on what the economy truly needs? Or is something else at play? Part 2, The Great Tug of War. Our story continues with the long and complicated relationship between the Fed and the White House. The Fed is supposed to be independent, like a referee in a sports game, making decisions based on the rules, not on which team is ahead. But this independence is often a fragile myth. There's a long history of presidents trying to influence the Fed. In the 1960s, President Lyndon Johnson, known for his big personality, supposedly even physically pushed the Fed chairman at his ranch to get him to change his mind on interest rates. Later, President Richard Nixon pressured the Fed to ease up on policy to help his re-election campaign. The idea here is that political leaders want a booming economy, especially around election time, and they want the Fed to help them with that, even if it might not be the best long-term move for the economy. Fast forward to today, and the tension is even higher. The current administration has been making some big changes to the economy, like new tax policies and changes to trade. These big shifts create a lot of uncertainty. The Fed knows these changes will have an impact, but they're not quite sure what it will be. It's like trying to navigate a ship through a storm when the wind is constantly shifting. But the real turning point in this story comes back to jobs. While the Fed is feeling a bit more comfortable about inflation, they're getting very nervous about the labor market. The number of jobs created has slowed down significantly. We are also seeing a rise in people filing for unemployment benefits. This is why many people believe the Fed will cut rates. They're trying to prevent the job market from getting any worse. So the stage is set. The Fed, feeling the pressure and seeing the cracks in the job market, is likely to cut rates on September 17. But here's the twist in our story. Part 3, The Quiet Threats. While all the public attention is on the fight between the Fed and the White House, there are quieter, more subtle threats building in the financial system. Think of the economy as a river. Liquidity is the water in that river, the cash and available funds that keep everything flowing smoothly. When liquidity dries up, it can cause problems. Two major things are happening that are draining the water from our financial river. A shrinking government deficit. For a while, the government has been spending a lot more than it takes in. But recently, the deficit has been getting a little smaller, which means there's less government money flowing into the economy, the end of an era. After the financial crisis and the pandemic, the Fed created special facilities to inject a massive amount of cash into the system. One of these, called the Reverse Repo Facility, or RRP, is now nearly empty. It's like a giant reservoir of cash that has run dry. On top of this, there are a couple of big dates coming up in September when a lot of cash will get pulled out of the system at once. Corporate tax payments and the end of the financial quarter. So even as the Fed prepares to cut interest rates and inject more life into the economy, there are these powerful, quiet forces working in the opposite direction, pulling liquidity out. The Fed and the government are strange partners, but they need to work together to navigate these hidden dangers. If they don't, the economy could face a rocky road ahead. And so, we wait to see what happens. Will the Fed's rate cuts be enough to counter these hidden threats? Or will the market, which has already priced in these cuts, be disappointed? Sweet dreams, and we'll see you next time on Midnight Macroeconomics.